There's no doubt there's urgent need for tax reform in Jamaica. Official data cited by Prime Minister Bruce Golding indicates that customs duties collected at the ports, for example, account for less than 6% of the value of the goods imported. Coupled with the fact that at least 40% of companies are not honoring their tax obligations and the difficulty of paying your taxes in Jamaica, the urgency for tax reform is brought into sharper focus. In fact, the latest World Bank report on ease of doing business indicates that Jamaica slid another rung in respect of the ease of paying taxes. The government is trying to build a consensus on tax reform with all partners, including the parliamentary opposition and the various private sector groups and professional organizations. This month, the debate on tax reform gathers momentum on all fronts. On September 3, 2011, the accounting firm PricewaterhouseCoopers held a seminar entitled Carving the Path for Jamaica's Tax Reform. Today we feature more excerpts from that timely seminar. All the participants, including Prime Minister Bruce Golding, noted the difficulty in implementing the kind of tax reform that would pave the way for lower taxes. Mr. Golding emphasized that the issue of tax reform was not a quick fix and cited the matter of the removal of tax waivers, which could fix the deficit but leave other challenges.
And therefore, a major challenge that we have to face is how do we reduce the high taxes that now prevail and yet come out at the end of it at least revenue neutral. I've wrestled with this because I'm telling you that with all the numbers that we have crunched, we cannot afford for the tax reform program to result in less revenue. And therefore what we have to do is we look to see how can we rationalize, how can we flatten this skewed structure that we now have. And we can't, in doing that, we can't avoid addressing some sacred cows. And the most huge of which is the issue of waivers and incentives. I've been told, I've never seen how the figure was arrived at myself, but I've been told that statutory and discretionary remissions and waivers and incentives amount to some 14% of our gross domestic product in value. And if that is true, then just consider for a moment that if we were to halve that, reduce that by 50%, we would in one stroke wipe out the fiscal deficit, if we were to do that. We need to appreciate that for every waiver or incentive that is granted, we have to shift that burden somewhere else. We have to jack up taxes on somebody else in order to plug that hole. And therefore we have ended up with this skewed array of taxes where some things attract zero tax, others attract 20% and 40% and 60% and 80% and over 100%. What we have to try to come out with in this exercise, we have to try to flatten that. We will never be able to get it dead flat, but we have to reduce those disparities.
Partner at PwC, Brian Dennin, addressed various issues including the reform of indirect taxation and where Jamaica should be going. One suggestion in the Green Paper on tax reform concerns customs administration fees, which Mr. Denning concedes has energized the productive sector.
I want to just deal with customs administration fee, because this is, in fact, if you were to pick one topic that's in the Green Paper that has caused a lot of people to exercise a lot of energy, and particularly you'll see the manufacturing sector agricultural sector and so on, particularly the manufacturing sector, have been energized very much by this proposal, is this customs administration fee that I mentioned earlier, where there's going to be this roll-up of these various levies into a customs administration fee. It's going to be, at the moment, customs user fee, there are a variety of exemptions, so it doesn't affect capital inputs on agriculture, it doesn't affect raw materials or capital inputs for manufacturing and so on. But the proposal is that this customs administration fee will pretty much apply across the board, and on top of that will be at a higher level, so up to 5%. So what is the effect of that? Well, first of all, it will add to the cost of goods imported, because remember, this is a fee, and it's not like an input tax credit where you can recover it on the other side when you make your supply. So it actually adds to your underlying cost structure. And it will add to what will be the effects? It will add to the raw material capital goods costs for manufacturers, for example, capital goods imported by the agricultural sector, operating and capital goods imported by those under incentive. At the moment, for example, tourism, those in tourism who have an incentive are relieved from customs duty on a range of capital inputs. However, they suffer customs user fee at the moment, but this is, and essentially with all of these things, is 2.8%. So this would jump up to 5%. And of course, commercial imports generally will be affected, including basic food items, for commercial importers, because obviously, the final consumer isn't importing basic food items, or they're purchasing them locally. So this is why people have got so energized by and excited and concerned about this proposal in terms of the customs administration fee.
Personal income tax gets priority in the Green Paper.
A big change is proposed is in terms of the personal income tax threshold. You can see there I've just done a movement in the personal income tax threshold in both Jamaican dollars and US dollars over the last many years, since 1994. And you can see in more recent times that it has moved up quite dramatically. And the proposal is to increase it from, it's currently at 441,000, and the proposal is to bring it up to 600, potentially up to 624,000. There's no proposal. In terms of personal income tax rates, as you know, we're currently at 25%. The Green Paper says, well, maybe we should be looking at this as well. And it throws out various simulations. Well, listen, if we reduce it from 25 to 24, this is how much it would cost us, and so on. Right down to 20%. But again, this is why what a Green Paper is. It just throws out these things for discussion. It does not say we're going to go at this rate. A lot of it's really going to come from whether we can model this correctly and see whether, we may not be able to even think about going down to 20% in personal income tax. And it may not be as much a priority as addressing some of the other issues.
PwC Director Mrs. Vivienne Morrison touched on what I call common sense issues, such as timely communication of taxpayer liabilities, as well as the timely processing of refunds in a scenario where last year alone over $30 billion was due.
It appears that at the end of 2010, there was a newspaper report that suggested that over $30 billion of refunds was due to taxpayers. The vast majority of these refunds, we believe, are due to financial institutions and also to pension funds. In fact, I was just made aware of a case where one particular pension fund has almost $1 billion in refunds due, tax refunds. When refunds are not paid on time, it means that the taxpayer incurs additional costs. The financial institutions incur additional costs awaiting on these refunds, and these costs have to be passed to their customers, who are the tax-paying public. The pension funds are not able to provide the pension returns that are required for the pensioners, and therefore it creates a real difficulty when these refunds are outstanding. I understand that the government has been mandated to make payments of these refunds under the IMF agreement, but and we noticed that there has been some progress in terms of the payment of the refunds, but this has been taking quite a bit of time, and we just wanted to stress the importance of making sure that these refunds are repaid to the taxpayers because of the overwhelming costs that they're being faced with by having so much money outstanding for so long a period.
That's our final presentation from that PricewaterhouseCoopers seminar on tax reform, early September 2011.